Hello there and welcome to Africa Business Weekly, your highlight of the biggest conversations that shape the continent's business landscape this week. It's countdown now to this Saturday's presidential election in Côte d'Ivoire as the country looks to its next phase of growth with higher stakes. Now from our East African desk, Ethiopia begins talks with China to convert part of the $5.38 billion it owes Beijing into yuan-denominated loans. Well, let's now get into the business of today with our first crossing to South Africa with my colleague Karabo. Hello, Karabo.
Hello, David. South Africa's agricultural exports to the US surged by 26% in the second quarter of 2025, reaching $161 million, despite the looming threats of tariffs imposed by the US. The increase was driven by a strong harvest and elevated global commodity prices. For more on this, CNBC Africa spoke to Wandile Sihlobo, chief economist at the Agricultural Business Chamber of South Africa at the Financial Times Africa Summit in London. Let's listen in for more.
As part of the delegation that was with Minister Ronald Lamola.
Yeah.
And I think the core thing for South Africa is one, the G20 priorities that the ministers already spoke about to the conference. But I think for me, it's really to listen in, which is one of the sessions that I was in about the geopolitics aspects. Because South Africa is at a time now where we are looking at saying we want to diversify our markets for a range of sectors in our economy and the sector that I work in, which is agriculture.
Yeah.
So sitting here, getting a sense of the geopolitical changes, but also outlining what South Africa wants to do in terms of trade is one of those conversations that we certainly had to hone in our engagements here.
Yeah. Let's talk about that aspect of your portfolio, because that's important, isn't it? Because we know what happened with the US and those tariffs, and of course, AGOA is now dead. Let's talk about that South African effort to find and diversify markets for agriculture. What are you guys working on?
I mean, look, AGOA is very important for South Africa, and we still do hope that it will be renewed when the government
revived
shutdown
in some form
finally ends. But I think the South African point has always been that AGOA, we are looking to viewing it as a transition to something that will be a trade agreement beyond that. So if we could get one more extension, then move there to getting it a trade agreement, because the US remains an important market. Think about this in agriculture. We're still putting up about 14 billion US dollars of agricultural products in the world. Sure. And I think this year, 2025, South Africa's agricultural exports will cross 14 billion US dollars for the first time, looking at the early data that we are receiving.
Despite these challenges.
Despite these challenges, what we began seeing, Godfrey, was this. In the second quarter of this year, as we got that 90-day pause, we saw that a lot of producers front-loaded their exports to an extent that South Africa's agricultural exports to the United States increased by 26% year on year to around about 161 million US dollars. But the point is that we want to retain that market. It's about 4% of our agri-exports, but also then make sure that in Asia, in the Middle East, we expand even more for us, but also over time, the region.
I want to get into detail about that, but I wanted to understand in terms of that focus on the US. You obviously would have done your risk assessments, and you would have looked at and seen the ability of South African producers to be able to retain that market in spite of that. How big a risk is that industry from competing at those higher tariffs?
I mean, right now we are effectively not as competitive because we are facing a tariff level of about 30%. In an event that AGOA wouldn't be renewed, then you would have to take 30% and you add the most favored nation tariff, which would be 3.6%. That would effectively put you at about 33.6% or so. Our competitors, like Chile, Peru, they have tariffs of around about 10%. So that makes their products more affordable. So if you are a citrus farmer in South Africa, particularly in the Western Cape, or a macadamia nuts exporter, or even ostrich, did you know that those cowboy boots that are there in Texas, there's a lot of them with our ostrich.
Did someone tell the president?
Exactly.
Someone should have told the president.
We want our ostrich to be more that side.
Yeah, so there's work to be done on that front.
Absolutely.
Let's talk about the diversification drive then. Because I've heard a lot now about missions to Europe, missions to Asia. I am not hearing about missions to Africa focusing on agriculture. Is that an opportunity, or is that still constrained by perhaps supply chains that have not been developed and that will take longer to develop?
I mean, I was just having this conversation with the South African Foreign Affairs Minister, Ronald Lamola, and he continues to underscore the point that the South African thinking in its economic diplomacy strategy is a butterfly strategy, which means we are rooted in Africa and then we begin to think outwards on where we should go. And even if you look at the data, it's not ideological. Take the farming sector.
Yeah.
About half of our agricultural exports, they go to the African continent. Then you have about 19% to the EU. You have about 24% that go to the Middle East and Asia and other regions. The key then is to say, how do we retain what we have in Africa while we continue to grow in other regions?
And in more news, emerging markets, including Africa, show low default rates and high recovery rates, challenging the perception of high investment risks. And this is according to the GEMS Consortium, who provided insights into the emerging markets by collecting data from 29 multilateral development banks and development finance institutions. CNBC Africa spoke to GEMS Head of Secretariat, Gregor Sigut.
What GEMS Consortium does is we collect information from 29 multilateral development banks and developing finance institutions on their performance in emerging markets, meaning we collect information on the occurred defaults, and then we also collect information which allow us to calculate the recovery rates of defaulted projects. In simple terms, we issued 3 reports earlier in October dedicated to different lending segments. One is for private counterparts, one is for public counterparts, by which we mean the counterparts which are more than 50% state-owned. And finally, we also have a report for our sovereign guaranteed lendings. The results of these reports actually show that the default rates are rather low. We see for private counterparts default rates around 3.5% and even lower for public and sovereign. On the African side, which is probably interesting for this discussion, we see that the private default rates are around 5%, with public around 4% and sovereign around 1%. And then finally, on the recovery rate side, we see quite a strong performance. So we talk about the recoveries when a lending operation defaults, and then efforts needs to be made to recover at least a portion of the money, and portions of the money recovered are actually significant. We see around 72% of recovered amounts for the private lending, even more, around 86% for public lending, and even more, around 95% for sovereign lending. And in particular for Africa, is interesting to observe even higher average recovery rates than those that I mentioned for the overall portfolio.
So what do these statistics mean, Gregor, when you look at them in totality? Because as I said earlier, and in fact it came up in a debate that I was moderating a few minutes ago, this perceived risk of investing in emerging markets and of course in Africa in particular. How do those rates compare against developed countries, and how does Africa compare against other emerging markets?
So in terms of putting these numbers into perspective, I think it's worth first mentioning that these are performances observed by MDBs and DFIs. These institutions have very elaborated practices, first in terms of project appraisal, but then also in terms of project monitoring, and in case something goes wrong in terms of what is done. Having said that, we are still actually observing that the perceptions which there existed before were a bit different for these regions, notably for emerging markets, because if we benchmark or we compare these results, we would actually see them at par with a single B-rated companies in developed world. So if that comparison means something, it probably means that the usual perception of default rates in emerging markets was probably different than what our numbers show. And the recovery rates are really very high. Now, in terms of Africa, we actually observe one of the highest recovery rates. This, of course, can be explained by several factors, such as different credit risk mitigants, such as collaterals or guarantees being used for the projects done. But nevertheless, observing recovery rates of around 80 or even more % for different segments is probably a very strong message.
And those were the major stories from Southern Africa this week. You can, of course, catch all these and more on our website. But until then, it's back to you, David.
Thanks a lot for the updates there, Karabo. It's now time to head over to East Africa with Tabitha.
Hello, David. From the east to the Horn of Africa, Ethiopia has started talks with China to convert part of the $5.38 billion it owes Beijing into one-denominated loans. Meanwhile, Fitch Ratings' affirmation of Ethiopia's long-term foreign currency rating at quote-unquote restricted default reflects ongoing Eurobond and commercial debt defaults. We spoke to Mered Fikeri Johannes, analyst and CEO of Pragma Investment Advisory, for more.
As always, yes, it is a big headline for Ethiopia in terms of to follow the footstep of Kenya, Sri Lanka, and also Hungary, which already currently they are already currently converting their debt in dollars to China into yuan, right? So that is a big milestone. I think it would account most of the debt that Ethiopia owes to China. Right now, officially the Ethiopian government has already started the discussion between the Chinese central bank, PBOC, and also the Export-Import Bank of China. So basically, this the biggest benefit right now, as you remarked it in your introduction, Ethiopia has a lot of foreign debt, and right now is undergoing a restructuring. So changing the chunk of almost $6 billion of debt into yuan with the partnering country, it reduced the pressure on the balance of payment of the country. It gives the country, especially the government, to service this debt, and instead of dollars, it could service it with yuan. So it's definitely relieve or reduce the pressure of the balance of payment of the country.
Yes, and looking at the savings here, how significant will they be in terms of the interest or currency fluctuations here?
Yes, so that one is being carried out. So I think just to take you one step forward, earlier this year, the Ethiopian government was in discussion with the Chinese central bank, the People Bank of China, to do a currency swap arrangement between the two central banks, between the National Bank of Ethiopia, the Central Bank of Ethiopia, and PBOC. So that arrangement has been already being finalized. So this has been in the making. So in terms of the currency fluctuation and putting the systems and also the systems and also determining the price and the mechanism is still it is something yet to be seen. But it's something yet to be seen. But at the same time, one thing you can clearly see is that since Ethiopia is a member of the BRICS nation, and China being one of a trading partner, and more importantly, I think China is one of the biggest debt that Ethiopia owes. So it is in the process of at least alleviating some portion of its balance of payment to service the debt.
And how is this likely to impact the relationship between China and its other standing with other creditors?
That's a good point, Tabitha. So at the announcement of this news came out, the Ethiopian Euro bond, which is currently being traded in London Stock Exchange, has rallied by up to 400 basis points. It was trading around 99 cents on a dollar. So which means, as you can see, the market is receiving it that as Ethiopia is currently negotiating its Euro bond with its creditors, the creditors, at least from the market perspective, they see that it would alleviate some of the pressure on the country's balance of payment, right? And then at the same time, I think one thing we have to agree is that the world is changing. I mean, mind you, there is a huge de-dollarization, and then at the same time, I mean, not only Ethiopia but also international investors and also mostly central banks are moving away from dollar progressively.
Despite significant progress, millions across Africa remain offline, either lacking mobile broadband access or more often not using it even when available. So how best can African countries tackle the root causes of the coverage and usage gaps, from affordability and digital literacy to infrastructure and policy? We spoke to African Telecommunications Union Secretary General John Omo for more.
The focus here for me is one thing: connectivity counts. And when we look at connectivity, or to use another term, access, we are talking of access in terms of reach, geographical reach. We are talking of access in terms of affordability. We are talking of access in terms of availability, in terms of relevant content. And Africa is still struggled with a number of challenges in terms of access, right from the level of infrastructure. Just about 37, I should think, % of our people are online in terms of consumption of internet. And even those that are online, about half or more than half is used for entertainment and not for productive uses. And so that tells you how we are consuming our bandwidth. Compared to the global average, which is about 70%, and if you talk of Europe and North America, much of internet usage, upwards of 50%, is on productive content and all that. And so Africa still has a number of challenges. Context here is that we are the regional African Telecommunications Union is the regional organization for ITU for Africa. There are also other regional organizations for other regions of the world, be it Americas, Europe, APT, and Eastern Europe. And so we have to grapple with these challenges at this meeting. The GSMA has put together wonderful sessions, regulatory tracks, skills development tracks, and several other tracks, infrastructure, and all that. And we are, debating as an African region in terms of the challenges that we are experiencing, the solutions that we can provide in terms of meeting those challenges, more so going forward.
Quite an insightful opening there. And Omo, when you look at the current challenges that you've just outlined, with very low connectivity rates, and still there is a huge infrastructure gap, I'd like to know, what opportunities are you seeing for Africa, and how can Africa position itself to shape a different future when it comes to leveraging on ICT technologies?
I think the opportunity in Africa is tremendous. In terms of the growth projections, we are the continent where telcos are seeing growth in terms of not just numbers, but profitability. And so the right investments in terms of the right skills mix, in terms of how we can use accessibility for productive uses, is tremendous. We have the most youthful population worldwide, very agile young people, inquisitive and looking for opportunities, because employment in a number of other aspects of our economy is constricted. And so we see ICT as the growth area where a lot more of our young people can be absorbed in terms of job creation, in terms of engagement, in terms of, the inquisitiveness, technology, innovativeness that is the spirit amongst many of our youth in Africa.
That's all from us for now. Stay with CNBC Africa for more insights on Africa's economic and digital transformation stories. Back to you, David.
Thanks for the updates there, Tabitha. Now, bringing the focus back to West Africa, it's countdown to Côte d'Ivoire's presidential election scheduled to hold on Saturday. Stanislas Zizi, chairman of Bloomfield Investment Corporation, says what's at stake is the volume of voters turnout and the incoming administration's strategy to transform the economy beyond recent wins.
As we approach election in 48 hours, you can sense a lot of tension in the air as two of the major political leaders has been prevented from running. And obviously, you have a huge tension. You can't, in the city, you cannot feel the enthusiasm for this election. So, as people believe that there's no surprise on who's going to be the winner. So today, what is at stake is to see how many, what will be the percentage of people participating to this election.
Now, let's talk about the journey to resilience as well. Now, we've also seen the near-term economic outlook favorable. Growth rate of about 6% last year, on track for 6.2% this year, and even 6.4%, looking at that average crossing over to 2027. Would you say the country has the chance of beating the odds, especially with the significant risks that come with this particular election?
You know that this country has a strong capacity to absorb shock. It's proven that for the past 2 decades. So it's not really what is at stake today. What is at stake today is that people want to see what is the strategy to transform the economy, and what is the strategy as well for the local company to control the economy. The economy is going to continue to perform. However, 80% of the wealth generated, the GDP is generated by foreign companies. So what people want to know here is what is the strategy of each candidate to assure that within the next 10 years, the Ivorian economy will be controlled by Ivorian, and the Ivorian economy will be transformed. But when it comes to the performance of the economy, the economy will always perform because it has some very strong fundamentals.
And talking about the strong fundamentals, we've also seen the country being able to improve fiscal deficit, cutting that from that 5.2% in 2023 to about 4%. And we are seeing the public debt also sustainable at about 60% of the GDP. But going back to your concerns here, how does the country now catalyze the next phase of growth, aligning these campaign promises with development agenda as a whole, solid development agenda? For you, what would be the key recommendations here? How should the next government approach the state of investment as a whole and the incentives needed for the local participation in the mix?
Yeah, I think that what would be the recommendation is that the new government should actually put more emphasis on the domestic economy and making sure that they create the feasible environment for local companies to become stronger. And this is what's going to guarantee a resilient economy on the long term. This economy is very performant, but it's not resilient on the medium, on the long term, in the sense that when you have extraordinary shock like what you had in 2011, and then foreign companies tend to leave, obviously the economy can actually slow down very significantly.
And next up, the Chief Executive Officer of Sterling Bank believes Nigeria's financial services sector is having a good run and the right time to move return on equity further. He highlights the Pan-African payment and settlement system is a tested infrastructure other direct payments can be built upon, while reiterating the need to accelerate lending to the real sector of the economy to drive the continent's industrialization agenda.
You have seen from our market, I think the financial services industry is having a good run. And this is coming after very difficult years. We went through the COVID years, and from there we also had a pretty slowdown just right after that. So this 2025 is the first time we're having some decent run. For Sterling Bank, our anticipation is that this is the period where we move our performance from return on equity in the neighborhood of the mid to late teens to 20s. We see our ROE getting to as high as 25% this year. We've seen that in the first 2 quarters. And the reason for that is simple. We have invested a lot of money. We spent a lot of years trying to build the infrastructure. The biggest of it was our core banking application, which we developed and deployed last year. What that has done is it's reduced a huge part of our cost that was tied to foreign currency. So we kind of free ourselves from the devaluation impact for core banking. And of course, that has driven our margin. We've seen our cost to income ratio improving significantly. We expect, we doubled our performance year on year when you look at the half year number 2024 against 2025. We think that the same will happen for the full year. So we're in the neighborhood ballpark of doubling the financial performance. And we see that as a trend for a couple of years to come.
Now let's also narrow down into the race to recapitalization as well. Now we've also had some of the results from the public of, and even looking at the 2024 private placement and rights issue as well. Now walk us through the big feedback you've gotten so far.
Okay, like everyone else, we were a bit taken aback when the central bank brought about new policies on capitalization. Although we were already ahead because we had started a capital process. We had actually gone ahead with a 50 million tier 2. In fact, we had an AT1 $50 million and we had a program for tier 2. So it wasn't very difficult for us to sort of transit from that into a private placement, and we were able to successfully raise $50 million very quickly. We then went on with the right issue, which was heavily oversubscribed. In fact, it was close to 50% oversubscribed. So again, we saw very strong demand from our existing shareholders. And we just rounded up a public offer now. I think it's the first public offer in a while that was open for only 2 weeks.
Yes.
And that was the case because it was clear to us from the demand we saw before the offer opened that there was in fact a lot of interest, and we didn't have a need to extend it for the entire 4 weeks or even the extended 6 weeks that we could have done. Surprising, yes, because there were a lot of other banks in the market that had raised capital. But deep down, we knew that the business we had built and the people who believe in us had been waiting for an opportunity to invest in us. We've gone for the last over a decade and a half without raising money from the public market. This is the first time we're coming to the public market, and we're quite delighted.
So what's the end goal here?
I mean, we've just completed roughly 200 billion naira worth of capital raise. We're waiting for regulatory approvals and we can get that out. So that's done. But the game for us is now that we have a financial holding company, we're going beyond just the bank. We have two incredible banks, Sterling Bank, which is, of course, is well established, and this is the 50th year of Sterling Bank, and the Alternative Bank, which is pioneering in many ways. It's not the only non-interest bank, but it's one of the most innovative that you see across the continent. So those banks are well capitalized now and funded. What we're now looking to do is other financial institutions that will complement that role. So we would be opening another $400 million program next year. We don't know if we would start raising next year, but we have the approval from the shareholders for a program like that, and that would go into the market next year. And that is driven not by regulatory need, but by our own desire to take advantage of some of the core advantages we've created. We have real comparative advantage that is embedded in our business now that would allow us to scale very quickly while keeping our costs down.
And that's it on the show this week. Many thanks, Karaba and Tabitha, for the regional updates, and many thanks to you as well for your company on Africa Business Weekly. I'm David Alabi. Bye for now.